Hey YouTube, this is Zach with Achilles Financial, and today I wanted to highlight something that I think is interesting in terms of the risk reward associated with the stock market right now. So as of December 27th, so this is multiple months ago, but the top Wall Street strategists gave their estimates for the S&P 500 over the course of 2023. Those estimates can be found down here below, where it'll walk through the strategist or chief economist and the actual firm. So out of those firms that you see right here, and again, feel free to stop the video here and take a look, and I will link this article in the description. But the main focus is that the average amount for where they expected us to end up this year is at 40.80, and that's based off of these 23 analysts. Some of them were more bearish at the time, some of them were more bullish at the time. So if I'm looking at this from a 40-80 perspective, let's take a look at where the market is today as we go into April 10th. So I popped over to the S&P 500 ETF Trust, also known as SPY, on TD Ameritrade. You can see that it is currently sitting at 409.19, which is only about 2% off of the 40-80 target that we just highlighted. So the question there is, what does this mean in terms of why would we look at and or evaluate the stock or the S&P 500 if we think that the total risk return is 2%? One of the reasons why we're going to continue to see a lot of money move from stocks into things such as money market accounts or CDs is because if we come up here above and we go to planning and retirement, or is it research and ideas, and we go over to our CD center, you can see here on the screen that this is showcasing our featured CDs. So at this point in time, I can get a 1-year CD for 5.1%. That is more than double the expected return that I would expect to get from the S&P 500 based off of those original expectations. So when we talk about index investing, which in my opinion would be the recommended version of investing for most investors, because it's going to give you a lot of diversity in your investments, as well as it's going to give you the capability to have some dividend income in there as well. Throughout that entire approach, my recommendation here, recognizing that I am by no means a financial advisor, this is just highlighting the risk reward, is that instead of putting your money into a volatile investment, you could get a guaranteed 1-year return of that 5.1%, and there's a significant number of strategies that you can leverage within the investment community here, where you can target things such as CDs or bonds or even money market accounts at this point in time are doing quite a bit higher than 2.5% or 3%, depending on what you would expect to see. So all that being said, this is just another reason why I would consider looking at other or alternative investments to the stock market so that you can further diversify not just your investing in the stock market, but your investments overall. So if you found this content helpful, please leave a like and subscribe. Thanks. Talk to you later.